issues you have with what we're seeing in terms of the bond buying, and what are you expecting out of the Fed?
Certainly, the Fed's goal here is to continue to push investors into risk assets away from government, government securities such as Treasuries, agencies, mortgage pass-throughs, to the extent that they can artificially keep rates low on government securities. It will be an incentive, a financial incentive for investors to look to other markets such as equities, corporate bonds, both IG and high yield, as well as structured securities. Those are ways to get cheap lending out there in the economy and to try to really give a jump start to the economy.
Now, you are overweight some of the riskier sectors, high yield, emerging market debt. What makes those two sectors attractive in your view?
Really, I mean, you could probably sum up our portfolio strategy by saying that we're underweight all the government sectors and overweight all the spread sectors. We think, because of what I just said, that the government sectors really are not attractive to the extent that you want to try to find return opportunity not only through incremental yield versus Treasuries, for instance, but also through the potential for spread compression as those markets continue to recover along with the U.S. and global economy. We think that's where the value is. So to the extent that we maintain a very significant yield advantage and also can look to some of the markets outside of our benchmark, the Barclays aggregate, which is about 71% governments. If we can look outside that benchmark to emerging markets, to the high yield market, to the non-dollar market, pro-cyclical currencies, is a great opportunity to pick up relative return potential.
And have investors warmed up to some of these sectors a bit more? Because we know everyone is so heavily weighted in fixed income, and there's still a lot of investors looking at government debt despite the fact that their returns aren't there.
Yep, certainly there's kind of a seesaw effect that happens in the market where you have periodic episodes of risk off, and there's this massive flight to the quality and liquidity of the government market. And so it pays for investors such as ourselves that are benched against a high quality benchmark to have some allocation to the government sector, in particular to Treasuries. We want to have some ability to hold value in risk off markets. However, as a whole, we still think that you need to look outside of the government market to pick up that incremental return and price appreciation potential.